Hello, everyone. Thank you for joining us. On behalf of the Environmental Finance Center Network, I'd like to welcome you to today's webinar, Water System Financial Management for California Board Members, Local Elected Officials, and System Owners. My name is Tess Clark. I work here at the Syracuse University Environmental Finance Center. Here's a map of our attendees today. While we're focused on the state of California, we actually managed to attract folks from other states. And there's actually over 100 people registered for this webinar. I know many of you are interested in receiving certificates of attendance. As a registered attendee, you can receive a certificate of attendance for participating today. This webinar has not been submitted to licensing agencies for pre-approval. You will need to self-submit in order to receive any available continuing education credits. The EFCN recommends that you check with your licensing agency to learn about its criteria, rules, and what you need to do in order to receive credit for your attendance. It is your responsibility to verify this information. Your certificate will be emailed to you within 30 days of the webinar date, and you should utilize this document to self-submit. Okay, this session is one of several webinars that we conduct for our Smart Management for Small Water Systems project. The EFCN provides training and technical assistance to small public water systems in all 50 states and 5 territories to help local water systems achieve and maintain compliance with the Safe Drinking Water Act. And here you can sort of see our areas, our different network members. Our network extends across the US, and we tend to have centers in most US regions. These are a couple areas of our expertise that we focus on. The EFCN provides trainings, workshops, and direct technical assistance on a variety of topics that you can see here, and this includes asset management, rate setting, leadership through decision making, managing drought, and many more. The EFCN also has a small systems blog. Our blog posts feature lessons learned from our trainings and technical assistance, and also descriptions of available tools and small system success stories. You can have, if you so choose, you will have the opportunity to subscribe to the blog at the end of the webinar. And one last resource I would like to point out to you before we get going is our online funding sources map. This tool can help you find the major funding sources for drinking water infrastructure projects for each state and territory. Here's how you can access those tables. On the EFCN homepage, go to the Resources tab and then click on Funding Sources by State. This will take you to a map of the country. If you click on the state that you're interested in, you will find a PDF table of the relevant funding sources for drinking water infrastructure for that state. The table looks like the image on the left of the slide. For each funding program, it includes the name of the program, a short description, and contact information for someone that you can reach out to. Before I turn the presentation over to our expert for today, I have some quick polling questions for you. So I'm going to get started with those. These just help us get a sense of who's joining us today virtually. So first, what kind of water and/or sewer utility do you represent? So do the best to pick which one makes the most sense for you. We've got for-profit, local government, not-for-profit, or another water system. And if you are alternatively not a water system, you can tell us that too. Looks like just about everyone's voted, so I'm going to close this poll in about 3, 2, and 1. And great, it looks like the majority of people are not-for-profit or cooperative associations, and we also have a strong showing from other systems such as authorities, districts, or schools, and also 16% are local government. Okay, and next, what size water and/or sewer system does your utility operate by the number of people served? So you can see our options range from very small to very large. So do your best to pick the one that makes the most sense for your system, or alternatively, you can select not a water system. And just about everyone has voted here, so I'm going to close this poll in about 2 seconds. And 1. Great, so a vast majority of folks joining us today are from very small systems. Of those that are water systems, 44% are 500 or fewer people served. And also a good showing from small systems, 501 to 3,300 people, 19% of us today. Okay, and one more polling question just to get the ball rolling. This one is about you. What is your role within the water system? And just do your best to tell us if you're an owner, a board member, or a local elected official, or if you're a manager. And if you're none of those things, you can select other. Okay, and it looks like almost everyone has voted or responded, so I'm going to close this. And wow, overwhelmingly people are board members today, so that's very good to know. Thank you. And on this note, I'm going to go ahead and turn the presentation over to Glenn. Glenn Barnes is the Associate Director for the Environmental Finance Center at UNC Chapel Hill, and he'll be talking today about financial management. So thank you, Glenn. I'm going to go ahead and turn the presentation over to you.
All right, thank you, Tess. And good evening, everybody. Thank you so much for joining us. This is the first of 2 webinars that we're going to be doing on water system finance. So the first one we'll have tonight will be on financial management for board members, local elected officials, and system owners. And then next Thursday, we'll be doing one on rate setting. So hope that you can join us for that one as well. So it'll be Thursday evening, 6 p.m. Pacific. Just also want to say thank you to everyone who is joining us from around the country. So as Tess mentioned, originally this was a webinar looking at California systems, but we had enough space in our webinar meeting area to invite others from around the country, and I think you'll find the information very helpful as well. Tess, I don't think I have the screen share just yet. Can you resend that, please?
Yeah, absolutely. Looks like I just need to do it one more time.
Thank you for your patience with us as we're, oh, I think we have to hide the poll results.
Oh. Sorry about that.
Okay. There we go. Okay. Thank you, everybody. Sorry about that. So as I said, we're going to be talking about financial management tonight and or this evening, and we're really grateful to have all of you with us. So my objectives for our hour together are to introduce financial capacity to individuals like yourselves who lead small water systems, and then take some time to explore best practices related to water system financial management. And I want to leave plenty of time, hopefully at the end, to answer your questions, either on the content we have or other finance issues that have come up. And as was mentioned in the introduction, we have the ability to work with any small water system one-on-one on finance and management issues. This is completely free of charge to your system. The only cost to you is your time to work with us. And so any of the issues we'll talk about today, from budgeting to financial performance to capital improvement planning or rate setting that we'll talk about next week, or any of the other finance and management topics that Tess mentioned at the top of the webinar, we're able to provide that help to you. So keep that in mind as we're going through our discussion today. So I want to begin by just talking about how EPA and the state and others kind of think about the capacities of water systems. So there are 3 main capacities of water systems that make up the concept of capacity development. And so the first one, and the one that we'll be focusing on this evening, is financial capacity. So broadly speaking, financial capacity is looking at whether your system has enough revenue to cover expenses now and into the future. So that's going to both look at, can you operate the system today? Can you afford all of those types of expenses? And then also, will you have money to improve your infrastructure and replace infrastructure over time? We're going to spend a lot of time talking about these concepts today. The second issue under water system capacity is credit worthiness. Now, many of you are from very small systems. Perhaps you've never been in a position to borrow money for your system, and maybe you're considering it, maybe you're not. But in case you are considering borrowing money or maybe have, how creditworthy are you? Are lending programs, banks, et cetera, interested in actually extending you credit and lending you money to improve the infrastructure of the water system? And then the third bullet here, which I think is really important, especially for the half of you listening in who are board members and those of you who are owners, is do you have fiscal management and controls in place? So this is not just having a, having a good financial position, which is really what the first two bullets are looking at, but the third one is, do you have internal controls in place to ensure proper fiscal management of the water system? So this is financial capacity, and as I said, this is what we're going to focus on today. But there are two other capacities that I want to mention. The first is managerial capacity. And managerial capacity, again, will be very relevant for those of you who are owners, board members, top managers, that you want to make sure you have appropriate staffing and organization of the water system, that you have people who are trained appropriately, and you've got that, that right set of people, whether it be operators, financial people, board members, et cetera, and that there is accountability of the ownership or the board. So there are controls in place that say, we are responsible for what happens within this water system. And obviously, drinking water is a major public health service that is provided. That's why we have these regulations from EPA. And we want to ensure that the people who are at the very top of the system, all of you who are listening in tonight on our webinar, are the folks who are going to have that accountability ultimately for the system. And then finally, the last capacity area is technical capacity. Now, I think as board members, owners, and managers, you are responsible for ultimately for making sure that these things are in place, even though some of you do not have the first bullet here, which is the technical knowledge of how to treat drinking water. And in that regard, some of you do have that background, but I know many of you do not. And for those of you who do not, I am right there with you. My background is in public administration and financial management. I really know the kind of management side of water, but I don't know how to mix chemicals. I don't know how to deal with chlorine, gas, or any of that kind of stuff. So you need to make sure that you have people with that technical knowledge to be able to run your system. You need to make sure that your water supply is adequate for the needs of your customers. And obviously, in California, if we were doing this webinar a couple years ago, even through maybe last year, the drought was going to be a big issue there. And so water supply is not just, oh, do we have a well? Do we have a surface water area that we're accessing? But is that water supply there during times when there may be a drought or other supply shortages? And then finally, is your treatment and storage and distribution of that water adequate? So some of you, if you're from, say, a school or an office building or something like that, where there's just a well going straight into the building, you may have very little storage. Treatment may be very simple, and distribution will just be the plumbing. But then for some of you are from local governments or from maybe like HOAs or condo associations, et cetera, you're going to have a little bit more elaborate treatment, storage, and distribution. So is that adequate? And so you take these three areas together, technical, financial, and managerial, and together they make up the water system capacity. And so you may hear a term about the state engaging in capacity development, and this is what they're talking about. And you also will see technical, managerial, and financial at times abbreviated as TMF. And so, these circles are overlapping for a reason, because there are some things within financial management that overlap with technical and managerial, some with managerial that overlap financial and technical, some with technical that overlap managerial and financial, and there are some that overlap all three areas. But generally speaking, these are the different types of capacities that water systems have. And we're going to focus really heavily on financial capacity and how you, as board members and managers and owners, can think about measuring that in some ways that the state of California has set up. And again, for those of you listening in from other parts of the country, the system that they have set up may be very similar to what you have in your own state, or at the very least, it's a good model to follow if a system is not in place. So where does this idea of technical, managerial, and financial capacity come from? Well, it's actually baked into the Safe Drinking Water Act. So the Safe Drinking Water Act, originally passed in the 1970s, is the legal framework that we all have to follow as regulated water systems. So this is what is setting health-related standards, and it's also what's setting monitoring and reporting standards, testing standards, et cetera. And in 1996, there were amendments to the Safe Drinking Water Act, and amongst those amendments were the establishment of this technical, managerial, and financial capacity development framework. And states were charged with essentially following the TMF framework, technical, managerial, and financial, implementing it within the state and ensuring that the water systems that they regulate are following these types of standards. So if you go, I've got a link here, and you'll get a copy of these slides, so you'll get the link directly, but you can go to the EPA site. This is from EPA. You can pull up the text of the Safe Drinking Water Act. Not the most thrilling read in the world, but you can read through it and kind of see all of the regulations that are there, including this idea of capacity development. And then once those 96 amendments were passed, all of the states and territories then had to pass state and territorial ordinances that followed up on implementing these federal standards, because in the case of California, and in fact, just about every state in the country, the state has the primacy of implementing these and enforcing these rules for water systems within the state. So in California, the State Water Resources Control Board is tasked with capacity development. And I have a link here to their website that explains a little bit of capacity development. It became part of Senate Bill 1307 in 1997, and that enabled California to implement the new provisions in the 96 amendments of the Safe Drinking Water Act. And part of that includes this technical, managerial, and financial, or TMF, assessment that you see on the bottom of the screen there. And so there are a couple of important links off of here. There is an assessment tool that the state has put together, an assessment form, and there are a couple of conditions where you need to fill that out. So I've just underlined those on the screen, and it must be completed by a public water system that are applicants for funding from the state. So through the state revolving fund, for example. If you are a brand new water system applying for a permit, or if your water system is changing ownership, you have to do this assessment tool. And there is an instructions document linked off of here, and there is a download of a Word document that is the assessment form. And then there's, for non-transient, non-community water systems. So those are water systems that serve people not where they live, but serve the same population over and over again, say like a large office building, for example. And community water systems, which is most of you, I believe, on the call tonight, who serve people where they live that have fewer than 10,000 people, which again are most of you. There is one assessment form, and that's the one we'll be using for our discussion this evening. If you serve more than 10,000 people, there's an alternative form. And then if you are a transient non-community water system, so you serve 25 or more people regularly, but not the same people, so you might be, say, a rest stop on a highway, something like that, there is a different kind of assessment form that you would look at. Now, for those of you listening in this evening who are not from California, my guess is your state either has an equivalent of this framework, and these types of assessments, or you can borrow one from another state like California that has done this, because my recommendation is, even though this technical, managerial, and financial assessment needs to be done in these three very specific situations in California, so applying for funding, new water system, or changing ownership, these questions that are being asked related to financial management and as well as technical and managerial really represent best practices for water systems. And we would recommend that you internally do this type of assessment on an annual basis, regardless of whether you're meeting some of these bullets here. And again, with our one-on-one technical assistance, if you have never done this assessment before and you don't quite know how to get started, we would be happy to walk you through it and kind of show you how it works. So I'm going to dive in on this assessment tool a little bit this evening. And so what you have is there's the instructions that I mentioned, and then the assessment form. Both of them can be easily downloaded from the website. And within the form, they have things broken out, once again, by technical, managerial, and financial capacity. So on the technical side, they're going to look at things like the feasibility of consolidating your water system with other water systems, a description of the system, whether or not you have certified operators, what your source capacity is, what your operations plan is, and your training plan for your employees, both the operators and the management level folks. Then on the managerial side, there'll be questions about ownership, questions about water rights, questions about your organization, questions about your emergency response planning, and then questions around policies that you have. And then finally, on the financial side, there will be budget projections and capital improvement plan section, and then a section on budget controls. And again, this financial section at the bottom, this is what we'll focus on this evening. Though if you have questions on the managerial side, we're happy to answer them for you. And if you have questions on the technical side, we're happy to put you in touch with some of our sister technical assistance providers, groups like Rural Water and RCAC, who would be able to help you more on those questions. Also, what California has put together with this guide, and it's linked from the same website, is a spreadsheet tool that allows you to do budgeting and capital improvement planning over a 5-year time horizon, which is what is required under the technical, managerial, and financial assessment. Now, this is a pretty simplified tool to use, but it's a good tool. It is free of charge, and it is obviously available not just to California systems, but those from any state. And we also at our Environmental Finance Center at UNC have some tools that would be happy to send to you as well in this regard. But this is a tool that can be freely downloaded, and then you're just filling in, for example, the yellow squares here, the orange squares, and some of the others are calculated for you. And so this is a really useful tool if you're in California and you're doing this assessment to download, because it really lines up very well with the questions you're being asked in the assessment. All right, so before we dive in on budget controls and budget horizons and things like that, let's just take a step back and say, well, why should we budget for the water system at all? For some of you, you are from very small systems. You're not a unit of government. You're maybe just a homeowners association. Is it really important to be budgeting at all? And I think we would say that it is for a couple of reasons. And the first is that it's important to understand your costs, because costs tend to go up over time. And one of the reasons for this obviously is just inflation. Things like the cost of energy goes up, the cost of chemicals goes up, the cost of infrastructure goes up. And we've done some analysis on looking at the construction cost index over time, which is a measure of inflation. You're probably maybe more familiar with the consumer price index, which is the blue dotted line on the graph here. These are a couple of measures of inflation that you could look at. And with a couple of exceptions for the consumer price index, during the recession in the late 2008, 2009 period, where it was essentially zero or actually slightly negative, the consumer price index. If you see the construction cost index, which is a better measure of water infrastructure, it has been a positive number every year for the last 30 plus years. So you should expect that the cost of running your water system will go up. And in fact, construction costs have been rising in the last 5 years about 2.6% per year, whereas consumer goods have only been rising about 1.3% per year. So even if from a consumer price index standpoint, you're not seeing a huge growth, from a construction standpoint, you probably are. And again, when we send the slide deck out to you, there's a whole blog post my colleague Shadi Eskaf wrote about inflation and the different measures that I think you'll find really interesting, and it's linked from this slide. All right, so that's the first reason. Costs are always going up. The second reason is because we need to be proactively thinking about capital rehabilitation or replacement. So you as a water system have some number of assets. It may be a small number, maybe a large number, it depends on the size of your system, but you need to be thinking about rehabilitating those assets or replacing them, not just repairing, which is kind of an ongoing operation and maintenance expense, just typical repairs, but talking about the really deep rehabilitation and replacement of assets. And so the very simple fact is that no matter how good you are at managing your assets, doing asset management, et cetera, which we really encourage you to do, the simple fact is infrastructure wears out. And so a piece of infrastructure like this beautiful new overhead storage tank will someday, without a significant amount of rehabilitation and upkeep, is going to look more like this. It is going to look rusted out and worn down, and eventually is going to have to be replaced. I don't think there's any type of water infrastructure that exists that will not have to be replaced at some point in time. So we want to be proactive when this infrastructure needs to be replaced. Because what we don't want to do is end up in a situation where the infrastructure gets in bad shape and we don't have the money to fix it. And I want to show you a picture of an example of this. So this is taken from an actual water system. I won't say which one, but this is a water tank, treated water. And maybe a little bit hard to see on your screen, but there's a leak coming out of the tank, going from kind of just below that black rubber tubing all the way down past just to the right of that black dial, there's a leak. And the leak was because there was a rather significant hole in this particular water tank. And when we took a close look at it, and maybe you're seeing that gray patch on the water tank and thinking, that can't possibly be what I think they used to patch the water tank, but it is in fact duct tape. Now, I just want to stress, we do not recommend using duct tape to fix your water tank, especially because this is treated water. And so, this is water that is going directly to customers, but this is a good example of a water system that just did not have money to do a proper replacement. And so this is why budgeting is really important from a capital standpoint. Okay. The third thing to talk about are changes to the number of customers served. And for some of your water systems, you may have customer base that's growing. Some of you may have a customer base that's shrinking. And those changes are really important because some of the cost of running your water system, the things like your infrastructure, and if you have paid staff, like a contract operator or paid operator, et cetera, the cost of billing, really none of these costs change based on how much water you treat and sell. The only costs that really do change based on that are things like power, chemicals, and if you buy water in bulk, buy treated water in bulk. So you want to be really sensitive to the changes in the number of customers served because your customer usage may go down, but your costs may not. And related to that are just general changes in revenue, whether they be expected or not. And one of the things you have to be really careful about here is whether or not there are customers within your water system that use a disproportionate amount of water. So for some of you, you may have an HOA or condo system and everybody is pretty much an even user of water. In that case, you're actually kind of good in this regard. But for some of you, especially those of you from local governments who may be on your water system may have a single large customer. It might be a hospital, might be a school, might be a factory. And if that large customer closes down, you might lose 25, 35, 50, 60% of your water sales overnight. And so it's really important to be budgeting and thinking about what the impact would be if there's any risk of a single large customer disappearing. Okay, so where do we start? You can take a look at the budget that existed last year. This is typically a line item budget, and make incremental changes. So generally speaking, you probably treat and sell about as much water year in and year out. You probably have a relatively stable number of customers unless you're really growing or shrinking. So you may want to just start with last year's budget, make a few tweaks, and you're finished. And that's the most common way that I think budgeting is done for water systems and for local governments in general, or for other types of environmental services. But the other possibility is every year to start at zero and to anticipate the revenues and expenses from scratch. And so neither of these particular approaches is more right or more wrong. The incremental approach is probably a little bit easier and quicker, but starting at zero may end up being a little bit more accurate because you're really diving deep on each of your line items. But either place is a good place to start in terms of budgeting. And ultimately, what you're trying to do is to assign your costs and your revenues to different buckets. So you're going to have operating costs, capital project costs, and potentially debt service if you borrow money. Then you'll have income coming in from rates or fees that you charge, might be included in the rent or homeowner fees, or maybe you meter directly, or if you're not a community water system, it may just be coming out of your operating budget. You may borrow money, which is income, and then hopefully you have some reserve funds. So that system income that you're getting from your customers can go in any of these buckets and go to operating costs, capital projects, debt service, and whatever is left over would go in reserve funds. And for some of you that are for-profits, that reserve fund would also be profit, essentially, for your system. But if you are borrowing money, debt should really only go to pay for capital projects. You never want to be in a position of having to borrow money to cover operating costs, and most lenders won't lend you money to do that anyway. But the debt here is really thinking about those capital projects. And then finally, the reserve funds, to some extent, can go to operating costs in terms of repair, but are generally going to go for capital improvements, so rehabilitation and replacement of assets, or possibly to pay off any loans that you have. So a very simplified version of water system finance, but ultimately with a budget, you're giving your best guess to all of these categories on an annual or multi-year basis. So the California Technical, Managerial, and Financial Assessment financial section includes a section on budget projection. And so they are asking you to develop a 5-year budget projection that lists all of the expenses of the water system. Now, this is going to include O&M costs such as salaries, power, chemicals, monitoring, etc. And again, that spreadsheet tool I mentioned earlier very nicely has a section called Operations and Maintenance Expenses, and all of them are listed out for you. Obviously, you may have more than these or fewer than these. You can make changes, but the tool does come pre-populated with some suggestions for you. Then that 5-year budget projection also needs to include administrative expenses. So things would be things like insurance and debt service. And once again, the tool lists these out. So that could be engineering and professional services, depreciation, insurance. The existing contribution to the capital improvement plan you see is in an orange cell. That's because there is a separate tab for the capital improvement plan, and that number is calculated automatically. And then there are some other reserves here and some other line items that you can fill out. And again, you can use other tools. If you already have a budget tool, don't feel like you have to use this even to do the state assessment. You're not required. But I do think it's a nice kind of free and easy framework to start with. And then finally, on that 5-year budget projection, you would also talk about funding reserve accounts. So that could be for capital improvements, O&M, contingencies, or other reserves. So I want to dive into these just a little bit. So a capital improvement fund or an infrastructure fund or a capital replacement fund, however you want to call it, the whole idea here is that you are setting money aside to replace infrastructure or significantly rehabilitate that infrastructure. And so this is important to do because that way you know that you have the money on hand to be able to replace assets. Now, again, if you want to borrow money and you're going to be paying debt service, you don't necessarily need to save in advance for replacing infrastructure, but you also just want to make sure that you are covering those capital needs over time. And as I mentioned, the spreadsheet tool has a tab where you can list all of your capital improvements, capital assets that you have, what the cost is, the average life, and then how much annually and monthly and per customer you need to be setting aside. So this is a very simplified capital improvement plan. We have a tool at our center. I don't have a slide of it, unfortunately, but we can send it out, the link to it out to you when we send the slides out. That is another, a little more complicated capital improvement tool that you can use. But again, what this is looking at is trying to get a sense of all the assets you have in your water system and how much they cost and how much you're going to need to save in order to replace them. And also linked from that same website where this tool is a document that will help you understand the life expectancy of your equipment. So it'll list different types of water infrastructure equipment and the expected useful life. And again, use your own experience. One of the things that I think about with transmission lines is if you're in a part of a country, like say California, where earthquakes happen, you may get less life out of your transmission mains or your service lines than you would in, say, North Carolina, where I live, where, in my entire lifetime, we have had one earthquake here. So, keep those kind of your own experience in mind. If you feel like you're getting more or less time out of some of your infrastructure, you can make adjustments, but this is a good kind of rough guideline that's there. Okay, so the second type of reserve fund would be an operation and maintenance fund or just a repair fund. So this is for known ongoing maintenance issues. So these are things you're going to plan out over the course of the year. You're going to know that you have to do some repairs and you're planning for it. But for every known ongoing maintenance issue, there are going to be contingencies or emergencies that we have to deal with. Unknown, unanticipated issues that may come from weather-related issues or other natural disasters, or they could just be an unexpected line break. Whatever the case is, a piece of equipment fails unexpectedly. You think about that useful life chart, it fails early. Do we have some money on hand for emergencies? And then finally, do we have some money in case our revenue has a shortfall? So this might be a case where, again, you've lost a large customer, or for some reason you get a lot of, typically get a lot of seasonal water customers coming and they don't come to your area for some unrelated reason in a particular given year. So you want to have money on hand to deal with some of these particular issues. All right, so how much do you need for your reserves? I'm going to give you a very unhelpful answer, which is it depends. And the reason I say it depends is that there is not a nationally accepted standard for capital reserves like there are for some other things. It really does depend on your comfort level. Do you want enough to pay cash for your most expensive piece of equipment, perhaps, to cover your costs if you had no revenue for 2 months, 6 months, 9 months, whatever the case is, or enough to cover the projects in your capital improvement plan? You have to make some decisions internally in your role as board members, managers, and owners as to how much money you want to set aside for the water system. All right, so we're going to do a polling question now related to reserve funds. And Tess, can you go ahead and launch that for us, please?
Absolutely. So you should be seeing a poll now, and it's asking you about your reserve funds. Does your water system maintain reserve funds for the following purposes? And just please select all that apply. So I'm seeing people are voting, and it looks like we've gotten a good amount so far. But if you're reading through and you're seeing these, just check each one that might make sense for you. All right, and it looks like getting a little closer. I'm going to give you 3 more seconds to put in your response here, and then I'm going to go ahead and share the results. So 3, 2, and 1. And great, so it looks like a vast majority have reserve funds for ongoing repairs and maintenance, and another 69%, slightly short of the 76% for ongoing repairs, do have reserve funds for future capital investment. Fewer folks have reserve funds for unexpected emergencies, and even fewer have some reserve funds for revenue shortfalls, and then only 7% actually don't maintain reserve funds. So that's the minority.
Okay, thank you. Okay, so in addition to these expenses, the California budget projection also wants a 5-year budget of revenues. So this is all of the sources of the system, of funds coming into the system. So that could be billing, assessments, hookup charges, withdrawing from reserves, grants and loans, other income. And again, for some of you, if you don't charge people directly, if you're a school, for example, some of this would just be the money that's budgeted from the general fund of your business or organization that specifically goes towards the water system. That would be the revenue that you would have. And again, that spreadsheet tool has a section on revenues received where it includes all of the things that we mentioned above, and you can plug in those numbers and it will total it up at the bottom. Now, one of the things that is part of this assessment in California, and I think is really, really a best practice that we talk about all over the country in the work that we do, is if the water system expenses and revenues are included in the overall budget for a facility, such as, say, a mobile home park or a school, you should really separate the water system expenses from the total facility budget, and if necessary, estimate. And part of the reason that this is really important to do is that, well, for one thing, if you're in California and you are filling out this form, it's required, but there needs to be a sense of the water system being self-sufficient. And so, you know, you may be a mobile home park that doesn't actually meter for water. You just charge a rent or a fee monthly that includes water, the space rental, upkeep of central, property, the roads, et cetera. Or you may be a school, again, that just has an overall budget. But what you need to do for this assessment is to actually estimate out how much of that very specifically is tied to the water system, both on an expense side and on a revenue side. And for those of you who are owners and managers, board members, if you are paid, I know many of you are not, but if you are paid, some percentage of your time that you spend related to the water system should be included in that budget of the water system as well. Okay, so we have one more polling question for you related to how you budget for water. So Tess, please go ahead and launch that for us.
Yep, absolutely. So our question is, does your entity budget drinking water separate from other activities? And your only options here are yes, no, or unsure. So as best as you can, tell us what you do for your budget. And looks like everyone is getting around to voting. We've got almost everyone. I'm going to give you 3 more seconds. 2 and 1. Great. And wow, a vast majority does not separate their drinking water budget from other activities, 45%. But 39% do, so that's pretty good. And very few people are actually not sure, which is good. Most people know what's going on.
And I'll say again, if you have not done this and you'd like to start doing this, again, that's something that we can help you. So there's a couple more items that should be part of the budget projection and capital improvement plan, or CIP. That would be your current or proposed rate structure. Now, for those of you listening in from California, some of you may be subject to Prop 218? And if so, and if you're officially filling this out for the state, you need to include the voter approval process that you will follow if a rate increase is planned. And also, some of you that are privately owned and you may be subject to the California Public Utilities Commission oversight, you also need to include documentation showing that you have submitted a proposed rate change or are planning to the Public Utilities Commission. For those of you not from California, if you have no idea what Prop 218 is, probably consider yourselves fortunate, but it's an extra step in California where local governments and other entities need to seek voter approval to increase things like water and sewer rates. You should also include the average annual cost of water per connection for the last calendar year, which should be pretty easy to calculate based on your budget. And then some documentation that revenues are covering expenses, including your reserve, or describe what your plan is to increase revenue to cover those expenses. And we'll talk a little bit about how to measure this later in the hour. We're getting, as we get towards wrapping up. Okay, so that is the first section to take a look at, the budget projection and capital improvement plan. Now let's just briefly talk about the budget controls. And again, this is where your role as a board member or as a top manager or owner is you need to be able to demonstrate that there are procedures in place tied to the finances of the water system. So one thing that the state is looking for are procedures in which one person records a transaction and a manager reviews and approves it. So this could be cash receipts and disbursements, bank accounts, or payroll, that essentially you've got one person dealing with the money and then a management level person signing off on that. So that's the first budget control that they look for to have in place. The second is that there are financial reports being prepared for review by the governing board. So this could be customer receivables report, check register review, bank reconciliations, budget comparisons. So what was your budgeted versus actual, comparative balance sheets, tax returns, etc. Now, again, these do not have to be audited financial statements, but you should have some type of financial report coming to you as a board and as top managers and are looking at that on a regular basis. And then also that there are criteria in place and guidelines for taking money out of reserves. For all the reserve funds that we've talked about today, that there are policies in place of how you can access those funds and what they are appropriate for. So you do want to make sure, especially for those of you that are not budgeting separately for water, again, the state is interested in seeing that there are reporting to you to ensure that there's not commingling of revenue sources. So, you know, if you're a local government, for example, and your water system is an enterprise fund charging rates, you should really be keeping that rate money separate from, say, the property taxes that you're collecting. And again, if you are an entity that does commingle the funds and you're kind of separating them out on the budget side, just have a clear idea of how those are being separated out. And then while I mentioned earlier that you don't absolutely have to have audited financial statements, it is a good practice to have a periodic review of the budget and your financials by a certified public accountant, by a CPA, or somebody who is really knowledgeable about how to run the finances of a water system and has training in that. And if you are going to be applying to the state for certain funding, you will need to submit 3 years of audited financial statements. So do keep that in mind, that you may have to go back and have those financial statements taken care of if you're going after some of that state funding. Okay, in our remaining time, I just want to quickly talk about a couple of ways of understanding your water system's financial position. And it really gets down to just, from a financial standpoint, how well are you sleeping at night? Is your system self-sufficient? Are you able to cover your debt service after paying for your day-to-day operations? If your customers stop paying their bills, how long can you maintain operations? And can your system meet its short-term obligations? These are all questions from a financial standpoint that you should be asking yourself, and there are actually ratios that go with all of these. And we've put together a really nice whiteboard video that explains each of these 4 ratios and how to calculate them. And I'd encourage you to watch that and to go through it. But I just want to take a couple minutes here as we wrap up to talk about one of those, which is operating ratio. And this is looking at your annual operating revenue for the water system compared to your annual operating expenses. And so obviously it gets back to that bullet earlier, is your revenue sufficient to cover the cost of running the water system? And so if you want to really do the best calculation here that includes that CIP calculation, what you're essentially including is depreciation. So depreciation is the annual cost of wear and tear on your water system. All assets lose value over time as they age without being restored by current maintenance. This is an economic fact for any water system, and this could be from a physical factor, or it could be that regulation has changed and you need to upgrade equipment, and therefore something that may still work won't help you meet the regulation anymore. I could easily spend an hour talking about depreciation, and in fact, we did. About a year ago, we did a webinar on this, and you'll get a link to it if you want to listen in a little bit more. But the way that the tool does it, and the easiest way to do it, is take the price of that asset. Let's say it is a pneumonic tank that costs $10,000. It lasts 10 years. That tank will lose $1,000 of value every year. So if you're budgeting that $1,000 and calculating it in this operating ratio, you're going to have enough money then to pay your day-to-day operations and to pay for future capital replacement. So obviously, you want this number to be greater than 1. You want more revenue than you have expenses, including that capital replacement. And really, ideally, you'd probably want this number about 1.2. Again, if you are interested in this ratio and how to calculate these and other ratios for your water system, we are happy to do that as part of our one-on-one help. And so just go ahead and request that when we do the polling question in a minute, and we can get up with you and walk you through the process of calculating some of these numbers. So I think with that, we've just got about 5 minutes left, so I'm going to stop so we can take a few of your questions before you go. But essentially, this is the framework of financial capacity that the state of California is following in terms of the budget controls and the budget amounts and the capital improvement plan. And you, as the top managers, board members, and owners, you are ultimately responsible for the financial health of the water system. And that financial health will lead to having the right infrastructure to be able to keep your customers safe and to provide water that meets the Safe Drinking Water Act and is good for your customers to drink. So Tess, I know we have a couple of polling questions to close, and then if you have any questions for us, if you've not done so already, please submit them through the questions box, and we'll get to as many in the next few minutes as we can.
Yeah, as Glenn mentioned, we are now going to go ahead and ask you, you can tell us here if you are interested in receiving technical assistance for your water system. If you click yes on this poll, someone will be in touch with you. This is your opportunity if you're immediately sure that you need technical assistance. So we'll give you a few more seconds to put your response in here, and then I'm going to go ahead and launch our next poll. Looks like everyone's done, so I'm closing this. And our second and last poll is, would you like to subscribe to our EFCN blog? Like I said earlier, we just share a lot of lessons learned and we share success stories. So this is your opportunity to let us know yes, no, or if you want more details, we can send you those as well. And everybody seems to be just about done here. So on that note, please go ahead and get your questions in. We do have a couple minutes, so now is a good time to get those questions asked. If you're still thinking about questions, I do have an evaluation that I'm going to send you through the chat, so stay tuned for that. And Glenn, I think we are ready to do a few questions.
Excellent.
Awesome. So first, How much interaction should we have with our auditors regarding the water system as they prepare financial statements?
Okay, this is a really good question. Thank you for submitting it. So as I mentioned, some of you are small enough that you may not necessarily be doing audited financial statements annually. It probably is a best practice to do that if you can afford it. And I think it's really important to understand that your auditor, your CPA who comes in, they are going to rely on you to provide them with essential information about your water system, including whether you feel like infrastructure is going to wear out more quickly or more slowly than expected, how much useful life is left, some of the things that you do in that CIP. You providing that information to the auditor will help them do a better job of estimating depreciation and the overall costs of running the water system. And that depreciation webinar I mentioned, we had a CPA that works with small water systems on. His name is Woody Trimble, and he talked about how that makes his job so much easier when the water system is able to interact with him at the time of the audit and provide some really important information. So definitely something we encourage you to do. You should not just be having the auditors come in and just kind of say, oh, there's the books, let us know when you're done. You should be able to answer some good questions for them.
Awesome. So our next question is California specific. So it regards increases and Prop 218, as well as the California PUC. The question is, do we need to worry about these regulations if we are a very small system under 30 users?
So I think the answer is it depends on your ownership model. So certain ownership types fall under Prop 218. I know local governments do. I'm not sure off the top of my head about nonprofit systems. And then generally under the Utility Commission, typically that is going to be most privately owned systems. So even if you're very small, you would really only have to be going before the Utility Commission if you charge a separate rate for water and you're changing that rate. So, if you are a small privately owned system of 30 people and maybe there's like just a maintenance fee that's paid, I don't believe you have to go through the Utility Commission. I'm not an attorney. I want to make sure to preface that. So, but my general understanding is it's not so much the size of the system that matters with either of those, but the ownership type. So typically Prop 218 is local governments. The Utility Commission is going to be privately owned systems. And if you're a nonprofit, you may fall outside of both of those.
Okay, awesome. So next question, this is about bonding for improvements. So how do you feel about bonding for improvements, which involves recovering the cost from all users that benefit from those improvements, versus a pay-go system, which would lay more of the cost on present users and eliminate debt serviced?
Yeah, so this is the classic question, right? Do you save in advance and pay, or do you borrow money and pay later? And I think, the answer that all of us would love is we get a grant and somebody else pays for it. But I want to stress this being about sustainable finance, and you didn't even bring that up in the question, is probably not going to happen often. I don't think that there is a specific right or wrong way to do it. I will say, from my perspective of being a financial manager and my background, that you really want to borrow money for and spread that cost out for infrastructure that will last for a long time. And generally speaking, water infrastructure does last for a very long time. And so it can be a really good way to borrow money and spread that cost out over time. Because while, yes, you are paying interest, as the buying power of a dollar changes over time, if you get a loan from USDA that's 30 or 40 years, by the end of that time, your debt payment is really not going to be as big as it is at the beginning. And so there you are spreading that cost out over the users who are actually using the infrastructure to the extent that the length of the debt matches the useful life of the infrastructure. Now, when you save in advance and pay, what you're saying is that today's customers will pay to replace the infrastructure that they're currently using. A lot of water systems use a mix of the two. But I think it really gets down to where rate setting and fiscal management is a little bit more art than science. And, is your philosophy that your current customers should pay to replace the infrastructure, or that current customers should pay for their current infrastructure? I think both of them are legitimate approaches, but it's good to be consistent and good to be intentional. So that that you're asking the current customers to either do one or the other and not necessarily do both, which we do sometimes see where systems both take out debt and they're fully funding depreciation. It means the current customers are both paying for the current infrastructure and they're paying to replace it. That is probably not the best system, but I think as long as you're intentional, either approach is good.
Awesome. I think we're just about out of time now, Glenn. So I do think we do have a couple more questions that we can get to. We'll follow up with everyone who submitted a question via email. And other than that, I guess, Glenn, if you have some closing comments, I'll throw it back to you.
Yeah, so thank you, everybody, for the questions. Sorry we weren't quite able to get through all of them. But as Ted said, I will email you in the next couple of days responses to all of that. And just first want to say thank you. I know for many of you, this is into your evening, and for some of us who are back east, this is quite a bit into our evening. But we wanted to be able to do it this time of day because I know for many of you, you are volunteer board members, you have day jobs, and that's why we wanted to time the webinar as we did. And just to say, again, please join us next Thursday for the second in the series on setting rates, and we'll be diving in on that subject a little bit more, and we'll go in a little bit more on these questions around Prop 18 and the Utility Commission regulations at that time that came up today. And I think it'll be a really helpful one to listen in on. If you're not able to listen in live, it will be recorded and posted on the EFC Network website as well. So just again, thank you all of you for joining us, and hope to see you back next week.